Okay, folks, let's get started. As always, as I mentioned last class, we're going to start every class with this kind of pre-class test. And today's test actually is, I think, for all the pre-class tests in this particular class, I think this one carries the most, weight in terms of lessons you can get out of it. So let me set the table. This is actually a page from a Harvard case. And as you know, I never use Harvard cases because Harvard manages to turn every case into a strategic case. Right? Everything's strategic. Right? So this is actually a case from the late 70s of a company called Kennecott. Kennecott was a copper mining company. Right? And in the late 70s, the antitrust laws were used to break up Kennecott. They were forced to divest themselves of a coal subsidiary called Peabody Coal. So they sold off the coal subsidiary. They got a few $100 million in cash on the divestiture. They got about $600 million, which created a bit of a problem. The company was worth about $3 billion at the time of this divestiture, and it had $600 million in cash, so it was 20% cash, and they were scared. What were they scared of? What does having a lot of cash potentially expose you to? They were worried about being taken over, that somebody would take them over with the cash. Say you're a company with too much cash. You're worried about being taken over. You don't want to have that cash. What's the most logical way to get rid of that cash? Give it back to the stockholders, right? That thought never even crossed their mind. So what would stockholders do with the cash? Crazy things like paying off mortgages and paying bills. You can't allow that to happen. So let me ask you the follow-up question. What's the dumbest way to get rid of cash quick? Buy something, right? Buy something fast. Buy something in a hurry. Guess which choice at that time Kennecott decided? Kennecott decided to go the second round. And here's what they did. They went to an investment bank. That time they went to First Boston. The late 70s, First Boston was the leading M&A bank on the street. And they said, can you help us find something to buy with a lot of cash? This is like walking into Bloomingdale's with $5,000 of cash in your hands and can you help me spend this money really fast? You're going to have a lot of people helping you for the rest of the day. Work on commission. Of course, First Boston found them the perfect target company. And it was incredible coincidence that the target company could be bought for roughly $600 million. This is again a rule. If you have X dollars of cash in your balance sheet and you go to an investment bank, magically the target company will inflate to take that X bill, which is what scares me about Apple going to an investment bank and saying, hey, can you help us spend all this cash? This morning I was reading an article that Apple should buy Disney. They could, $137 billion, they could buy JP Morgan and then get JP Morgan to value themselves for the acquisition. I don't know how that would work, right? So First Boston comes back with this company called called Carborundum. So these are the numbers for Carborundum. Okay? That First Boston projected out as cash flow. So here's what I want you to keep focused on. Don't get distracted by estimation questions. Maybe they use too high a growth. Let's assume that First Boston's estimates are not going to be contested. I want you to focus on pure mechanics. I'm going to go through how they estimated the cash flows. And as I go through this process, remember what we left off last class with? Which is if the cash flows are cash flows to equity investors, you have to use the cost of equity. The cash flows are cash flows. Before debt payments, you have to use the cost of capital. So I'm going to describe how they estimated the cash flows, and I want to focus in on what type of cash flows are these. So here's what they started with. They started with net income. Already I've given away a part of the game, right? They started with net income. From that, they did a little, they set aside, in fact, you can see they misspelled capital in there, but that's okay, that sometimes does happen. But they set aside what they needed to reinvest, which wasn't very much as a mature company, and they set aside what they needed to pay out to the debt holders. So they started with net income, they subtracted out working capital and reinvestments, and then they also subtracted out whatever payments they need to make to debt holders to come up with their bottom line cash flow. So remember what I asked you to focus on. Keep your eyes on what type of cash flow is this. Okay? So everybody comfortable with the cash flow computation? So here's my question. You got the cash flows now on carborundum. It's a target company in this acquisition. I've told you how they calculated the cash flows. I'm going to give you 6 choices in terms of discount rates. And I'd like you to tell me which discount rate I should use on these cash flows. You have an acquiring company. You have a target company. Acquiring company is Kennecott. The target company is carborundum. You will also have this combined company after this deal that will, let's call it some merged company. There's a cost of equity and a cost of capital for each of these entities. So let's do the easy part first. Given the way I described the computed cash flow, start with net income, subtract out reinvestment, subtract out debt payment, should I be using cost of equity or cost of capital as my discount rate? Are these cash flows to equity or cash flows to debt? I'm sorry, cash flows to the firm. Cash flows to equity. And what gives them away? What did they do that makes them cash flows to equity? First, they started with net income. And I told you that was already a giveaway. Why is it a giveaway? Because net income is after interest expenses. So already you know the starting point is after interest expenses. And then because they subtract our debt payments, you have cash flows to equity. Yes, okay. So discount rate should be the cost of equity. Now comes, I think, the tougher question. You have 3 different choices for the cost of equity. Which of these choices should I use? Before I do that, anybody here lined up to go into M&A after this class? Okay, so you're going to be my guinea pig. Right? So you're going to go into M&A, and if you answer this question wrong, will you still go into M&A? Okay, that's okay. You can still, they screw up all the time in M&A anyway. It's not, one more screw up is not going to make a difference. Okay, which one should I use? Let's see if you can justify yourself, because in fact, which of these 3 numbers should I use as my cost, as my discount rate to value? The target cost of equity. Does everybody agree with that? Let me play devil's advocate, because you're going to run into this. In fact, that is actually the right answer. The target cost of equity is carborundum's cost of equity, 16.5%. Here's where you have to be ready to play defense. But it's Kennecott that's spending the money. It's their equity. Why shouldn't I use? Give me your argument against why I should not use the acquiring company's cost of equity. Okay, now you're digging a hole here for yourself. Because now let's assume the target company has been safer. Are you saying that you just use the higher of the 2 numbers? No, but then the argument you use should not be used, because you said the target company is riskier, because then if the target company is safer, your argument is going to get undercut by saying, hey, the carborundum's cost of equity is higher, I should have used that. So it's not because the target company is riskier per se, but because its risk is different from the acquiring company. Maybe that's what you meant to say, but I wanted to be, you got to be very clear. It goes back to corporate finance 101. You know what the rule in capital budgeting is? When you have a project and you're trying to compute the net present value for the project, what's the rule in terms of the discount rate you should come up with for the project? It should reflect the risk of the project, not the risk of the entity looking at the project. You cannot, as a safe company, make a risky company safe. You have to use the risk of that target entity, the project, and that's exactly the principle you should use here as well. Yeah. None. And here's why. If you're valuing a public company, you know how you compute cost of equity, right? You use a beta. What does beta measure? Risk you cannot diversify away. Once you go down that road, combining 2 companies, combining 3 companies, because if you'd estimate a cost of equity for a private business, and that's actually an open space, because there you might say, look, I'm reflecting all risk, then you might be able to argue about less risk, maybe there's no opening here. If it's public companies, and these are 2 public companies, you cannot make a risky company. And I'm going to give you a very sad statistic. In half of all acquisitions, you know whose discount rate gets used to value the target company? It's the acquiring company. It is, I don't even know the right way to describe this. It's criminal. It doesn't make any economic sense. In fact, to show you how deep this is, about 5 or 6 years ago, I was asked to come into GE and talk to their divisional heads about Corporate Finance 101. Everything I do is Corporate Finance 101. I don't know much about beyond 101. And it was about acquisition. So I go through this acquisition process, okay, and I talk about this first principle, and there's very sheepish looks around the room. So I said, you guys do the right thing, right? You're GE, you've been acquiring a lot of companies, you do this all the time, you're very sophisticated. They said, yes, but no, we do use GE's cost of capital to value all these target companies, but it's okay. And I said, what do you mean it's okay? They said, we're so big and they're so small, it probably doesn't make much of a difference. To which I came back with my favorite analogy. You ever had a Krispy Kreme donut? This is like killing yourself right there, right? I mean, 15,000 calories in that one glazed donut because it's triple fried with sugar all over the place. I said, let's assume you buy a Krispy Kreme donut. It's 1,500 calories. You cut it up into 24 small pieces and eat it one small piece at a time. All 24 pieces. How many calories have you just consumed? Still 1,500, right? So basically, you do 24 small acquisitions and you screw up the same way in every one of them. Because remember, the screw up is never going to be in your favor. It's always going to be cutting against you. It's just as bad as doing one big acquisition and screwing it up one time. Now let's return to this case. This is First Boston, right? So we've already decided, given the cash flows, the right discount rate to apply is 16.5%. So when would I use the blended cost of equity? There are a set of cash flows. You'd use the blended. In fact, we're going to do this in an acquisition valuation, but you can probably guess. What part of the acquisition valuation would you use the blended cost of equity for? Not even the debt part. If you have synergies which come from the combined company, then you have the argument for using a blended cost. But that's a separate issue. So if you want to value, that's why you cannot value synergy as part of valuing the target company. You always have to separate it from the rest. But we'll come back and talk about those mechanics. But this is a rule to which there are zero exceptions, none. There is no argument you can give me for why it's okay to use the acquiring company's discount rate. Now, think about First Boston. What's the worst possible choice you could make as a discount rate in terms of violating every first principle you can think of? What would you use? If I asked you, pick the most perverse choice you can make, the worst, you'd pick Kennecott's cost of capital, right? Guess what First Boston used to discount these cash flows? It was Kennecott's cost of capital. There are two ways you can look at this. They knew it was wrong, but they did it anyway because they cynically wanted to push up the value. I actually have a scarier vision. They just did not think through the process. And this is what happens when you have two teams. One team works on the cash flows, the other team works on the discount rate. They don't meet till 5 minutes before the deal gets done. I mean, if you ever worked in an acquisition, everything is always in a hurry, right? Everything happens in the last 15 minutes. Things are coming together. I wouldn't be surprised if nobody even thought about the fact that the numbers didn't match. You take these cash flows that they've estimated. That's why I said don't even contest the cash flows. Take their cash flows as a given. You discount it at 10.5%. You can justify the $66 per share. Makes complete sense. You get about $650 million for the value. But you take exactly the same cash flows and discount it back at the right cost of capital. It turns out they paid about $20 per share too much for the acquisition. To complete the story, guess who was running First Boston's M&A department in 1979? So they had co-heads for the M&A department. It's Bruce Wasserstein and Joe Perella. It's testimonial that no bad deed ever goes unrewarded on Wall Street. Because how did they punish these guys? They created Wasserstein Perella. They created more damage for the next decade. How did those guys get punished finally? Well, Dressner paid them $2 billion for their valuation expertise. I can't make up these things. Valuation expertise? But this is exactly what happens when you lose sight of what you're trying to do. When the deal becomes the focus of the exercise, it's easy to make first principle mistakes and slip through. Here's the other thing I want you to remember. Sometimes you look at a valuation, you see the name on top of it, and you'll be intimidated. Goldman Sachs did it, so it must be right. Do not take anything for given. It doesn't matter whose name you see on top of the valuation. Step back and ask the same first principle questions you would ask if a novice did a valuation and said, can you tell me whether this valuation makes sense? Because you'd be surprised at how many things slip through into valuations that should not slip through, that are not estimation problems, that are first principle problems. Any questions? So file that away because, again, this is something we'll come back and talk about in the context of acquisitions. But I think the biggest lesson in acquisitions is already kind of laid out on this page. So let's cement this principle. There are lots of first principles we'll kind of list out. Not even that many. About 5 or 6 we'll list out in the course. Here's the very first one. If you discount, and this is page 11 of your lecture note packet, so if you have the packet, pick it up. If not, no, I have a few. No, there have a few more still. Anybody need the pages? We didn't. I'll pass it back. So the first principle here is discounting cash flows. You've got to match the cash flows to the discount rate. If you mismatch cash flows, all is lost. This is how you make mega billion-dollar mistakes. What do I mean by that? If you discount cash flows after debt, the cash flows are after debt payments, like the cash flows you saw with carborundum, then the discount rate, if you discount those cash flows at the cost of capital, like First Boston did, you're going to overvalue the company. If you take cash flows to the firm and discount them at the cost of equity, you're going to undervalue the firm. In fact, I'll use that example I finished the last class with. Remember I used an example to show that you get the same value? Let me show you 3 things you could have done that you shouldn't do. So put a big X on this page because you're doing the quiz, you're in a hurry, you might come to this page and say, okay, I found the page and do exactly the wrong thing. So these are the things you're not supposed to do. First is to discount cash flow at equity at cost of capital. You'd have overvalued the company by $175 million. Why? Because you used the wrong discount rate. If you take cash flows to the firm and discount the cost of equity, you'd have undervalued the company by $260 million because you used too high a discount rate for those cash flows. And of course, I've seen this happen as well. I've seen people discount the cash flow to the firm at the cost of equity. They're so confused about what they've just valued, they forget to subtract out the debt. In which case, you've massively overvalued the company because you've forgotten an entire commitment that you have. So step back and think about that very first principle when you think about looking at discounted cash flow valuations. So let's set the table for discounted cash flow valuation. When I think about the sequence of steps I have to go through for a discounted cash flow valuation, the first step is I need a discount rate. The cost of equity or cost of capital. So I'll start with that first step in the process. Once we've got the discount rates, we'll turn to nailing the one thing we should know before we get ambitious. What were the earnings and cash flows in the most recent year? That should be easy, right? We're going to find out that even that very simple step of looking backwards is not as simple as it looks. Third step, we have to estimate some kind of future earnings and cash flows. It usually requires a growth rate and margins, and that's where, in a sense, you get stressed out. You say, I have to make these predictions, I could be wrong. Well, welcome to the club. Everybody's going to be wrong. And then we have to figure out when your company will hit stable growth. You see why you have to do this? Because a publicly traded company, at least in theory, could keep going and going and going and going forever. You can't estimate cash flows forever, so at some point in time you stop the game. That's, of course, that magical terminal value number that you see in a discounted cash flow valuation. We'll talk about when your company should be put in that point, because it's not always 5 years or 10 years for every company, contrary to what you see in models. And you have to make your company fit into the characteristics of a stable growth company. So we're going to start with discount rates. We're going to move to the current earnings and cash flows. We're going to project out the future. We're going to put closure on the valuation. And then we have to decide which of these different discounted cash flow models we have at our choice basically fits the company. So if you break things down, discounted cash flow valuation, here's the way I think about the inputs that go into any discounted cash flow valuation. The first set of inputs relate to cash flows from existing assets. And those cash flows can be either before debt payments or after debt payments, just like you saw for The second input you need to do valuation is some kind of a growth input for the future. What is the growth going to be? There again, depending on whether you have an equity perspective or a firm perspective, that growth rate can be different. In fact, rather than talking abstractions, you guys are going to value the equity in a business. You're going to value the entire business. When I ask you what's the cash flow, if you're the equity guys, you give me the cash flow after debt payments. This is what the cash flow is after I made interest expenses and principal payments. Whereas when I ask you the question about cash flows, you give me the cash flows before debt payments, before interest expenses, before principal payments, before cash coming in. Then I ask you, what's the growth rate going to be? The growth rate you need to give me is a growth rate in equity income. Does it sound abstract? Net income, earnings per share. But when I ask you that question, the growth rate you need to give me is a growth rate in operating income. You see, this is splitting hairs. What's the big deal? For a healthy company, as you move down the income statement, think about what happens. You have 3% revenue growth, which is probably going to be 5% operating income growth, which is probably going to become 8% net income growth and 10% earnings per share growth. Why is that again? Why, as you move down the income statement, the growth rates tend to go up? Daniel? Leverage, and the first stage is revenue to operating income. The leverage is fixed cost, variable cost, operating leverage. From operating income to net income, it's financial leverage, interest expenses. But what about net income to earnings per share? At least the U.S. companies, what's the culprit that causes earnings per share growth to be higher than net income growth? What have U.S. companies been doing increasingly over the last 2 decades? Buying back shares, right? But the reason I bring that up, and this is something we'll re-emphasize when we talk about growth, is not all growth is created equal. So sometimes you see a person value a business, and you say, where do you get the growth rate? And they'll say, I got it from Yahoo Finance. I said, really? That's easy, huh? So where do you get in Yahoo Finance? I went to that analyst estimate of growth, and they gave me the number for the company, and they do, right? For many of these companies. What's wrong with that, though? Even if that growth rate is right, it's not the growth rate you should be using if you're valuing the business, because that's a growth rate in what measure of earnings usually? What do analysts project growth in? Earnings per share. And you're taking that earnings per share growth and putting it into operating income. You're going to overvalue the company. So the growth numbers you might give me can be very different. Third question, I ask you, what's the discount rate? And ask that of equity people, the discount rate you're going to give me is the cost of equity, but from you, it's going to be the cost of capital. The final question, the answer should be roughly the same. When will your company be a mature, stable growth company? The answer. But you can see how your answers to inputs in this kind of cash flow valuation is going to be framed by, are you valuing the equity in the business, are you valuing the firm? Now I'm going to take this page and essentially talk about how the inputs are going to be different across models. Because here's what I don't want you to end up doing. If you think about each discounted cash flow model as new and different, you're going to get overwhelmed because you're going to run to model 1, model 2, model 3, model 4, and say, there are 15 models to value companies. How the heck am I going to remember all of those? Here's a very simple way to think about what these models have in common and how you can keep track of all of them. So I'm going to take the dividend discount model, which is the oldest discounted cash flow model, as I said around. I'm going to talk about using potential dividends instead of dividends. In other words, what could this company have paid in dividends? I'm going to give it a fancy name, free cash flow equity, but it's really the cash you could have paid out without cutting into your growth or whatever reinvestment needs you have. And then I'm going to talk about the firm valuation model. So dividend model, potential dividend, free cash flow equity. The inputs I asked you for were cash flow, growth rate, discount rate, steady state. Let's take each of the inputs and see how the models are going to be different. I'm going to ask you, what is the cash flow in the dividend discount model? Your answer is very simple. It's, hey, whatever I got is dividends, right? So it's the easiest model to use because you just look it up. But if I ask you in terms of the free cash flow equity model, you have to do a little more work. You have to look at the cash flows left over after debt payments, reinvestment needs, and taxes. And if you're doing a firm valuation, you're going to be cash flows before debt payments, but after reinvestment needs and after taxes. So your cash flow is going to be different depending on which model you use. When I ask you what the expected growth is, dividend discount model is an equity valuation model. So the growth you're going to give me is growth in equity income and dividends. With a free cash flow equity model, it's going to be equity income and potential dividends. With a firm valuation model, it's going to be an operating income and free cash flow to the firm. Your discount rate is going to be a cost of equity for the first two models. They're both equity valuation models. It's going to be a cost of capital for a firm valuation model. And finally, when I ask you, when will your company be in steady state, I'm asking, when will your dividends start to grow at a constant rate forever? I'm asking the same question, the free cash flow equity model. When will your potential dividends grow at a constant rate forever? Or when will your So what I'm trying to say is don't think of these models as unique or different. They're basically coming from the same place. What you estimate might be different, but they share a common theme. So what I'm going to lay out is a big picture for the three models so you can see how much they have in common. So if you ask me to picture the dividend discount model, here's what it looks like. I'm going to estimate dividends, which is usually going to be a function of the net income and the payout ratio. For the growth rate, I'm going to look at how much of the net income gets reinvested back in the company. That's called the retention ratio. And how well I invest that income. That's the return on equity. So that drives the growth in the dividends. The cost of equity is the discount rate, and what I get as a present value is the value of equity in the company. So I'll give you a minute to absorb it. So net income payout ratio gives me the dividends. Retention ratio times return on equity gives me the growth rate. Cost of equity gives me the discount rate. You bring them all together. You got a value of equity, the dividend discount model. Now let me show you the potential dividend model, the free cash flow equity model. Instead of looking at just the dividends, I look at what you could have paid out in dividends. And then we'll come back and revisit this in more detail. But to estimate potential dividends, here's what I'm going to do. I'm going to start with net income, still, because it's still an equity cash flow. I'm going to subtract out what you need to reinvest. And we'll go through this in detail, as I said, but we're going to reinvest in long-term assets. You're going to reinvest in working capital. I'm going to subtract that out because I can't take that cash flow out of the business. And if you have debt to repay, I'm going to take that out. But I get a little bonus with debt. If I borrow money, it comes into the firm. What I end up with at the bottom is my free cash flow equity. So it's a little more work because I just don't take the dividends from last year. I take what you could have paid out as free cash flow equity. So if I did this for Apple, the actual dividends, if you look at the trailing 12 months, is $10.60 per share. That's the dividend they initiated last year when they said their free cash flow equity last year was close to $40 per share. So I'm replacing the $10.60 with the potential dividend. When it comes to reinvestment, rather than use the retention ratio now, because I was assuming with the retention ratio that anything you weren't paying out as dividends was going into the company. But if you're just holding it as cash, it doesn't really help me. So I actually am going to count how much you reinvest back in the business of the company. That's what the equity reinvestment rate is, the portion going back to the business. And it really is not going to be complicated. If you tell me what your net capex and change in working capital is, I can figure out what you're actually putting back in the business. And the return on equity basically measures how well I'm reinvesting in that business. So basically, I'm still looking at equity income and reinvestment, but I'm focusing entirely on potential dividends rather than actual dividends. Everything else about the model stays the same. And one more thing though, if you decide to do this free cash flow equity valuation, you can actually, if you choose to separate cash from everything else, value just the net income from operating assets separate from the net income from cash assets. Why would I want to do that? We talked about this in, I think, the first class. The income from cash is riskless. So when I attach it, when I put it all together, I run this danger of discounting something that's riskless at a risky rate. So when you do a free cash flow equity model, it's probably sensible to separate the cash from everything else, value everything that's not cash, because value cash is simple. Just add the cash on at the end, and I get a value of equity in the business. And in the final approach, I look at valuing the firm. Here, instead of estimating the cash flows left over after debt payments, I look at cash flows before debt payments. And here are the subtle differences. Rather than start with net income, it should be fixed. That's after-tax operating income, not net income. So I've carried this over to the previous page. So just cross out the non-cash net income and replace with the after-tax operating income. So I'm going to start with after-tax operating income. So this is page 18. That first line should be after-tax operating income. Then I subtract out the net capex. That's my investment in long-term assets. I subtract out the change in non-cash working capital. That's my investment in short-term assets. I have a cash flow to the firm. So my growth rate, I'm looking at growth in free cash flow to the firm. So basically, I'm looking at operating income, net of reinvestment. The keys here are how much am I reinvesting? That's my reinvestment rate. How well am I reinvesting? My return on capital. I have growth in operating income, value of the firm. So as we go through the next few weeks, you're going to see me go back and forth between these models, and you're going to say, well, he's talking about three different models. I'm actually talking about one basic discounted cash flow model. What's varying across the models is what I'm focusing on and what I'm trying to value. So think about what they share in common rather than what they have as differences, because let you kind of get past those details and say we're doing the same thing over and over again. We're just taking different perspectives on how we estimate the numbers. So that's kind of, I'm setting the table because obviously at this stage, if you've never done valuations, you know, I've never seen capex minus depreciation. I don't know, how do you estimate change in working capital? There are lots of input details, and that's what the next 6, 7, 8 sessions is going to be. It's about getting those numbers nailed down. What tax rate do I use? What's in capex? What's in depreciation? What does working capital include? How do we come up with the cost of equity? What's the cost of capital? So I know you will have lots of questions. You've never done valuation, but we'll nail them one at a time. But I want you to keep your eye on the big picture rather than get stuck or caught in the details. Always step back and think about why we're doing what we're doing and where it fits into the big picture. So the next sessions, as I said, we're not actually going to value companies. We're going to talk about individual inputs. And the first input we're going to talk about is discount rates. Do discount rates matter in discounted cash flow valuation? That's a silly question, right? It says discounted cash flow valuation. But I'm going to make a point that I'll come back to over and over again. They don't matter as much as you think they do. And the reason I say that is in valuation, I think we spend far too much time estimating discount rates and not enough time thinking about cash flows. If you've ever done a valuation, it's 80% discount rates, 20% cash flows, right? All this little finessing, getting the third decimal point nailed down. Did I get the right beta? What's the risk premium? Right? I would much rather you spend 80% of your time on the cash flows, 20% of the discount rate. So they matter, but not as much as you think they do. So let me set at least the first principles on discount rates on the table before we start delving into the inputs of discount rates. Remember that consistency point I made? If you have cash flows to equity, you have to discount the cost of equity. If you have cash flows to firm, you have to discount the cost of capital. Let me add to that consistency principle. If you tell me what currency your cash flows are in, your discount rate has to be in the same currency. Today we're going to talk a lot about why currencies matter, but it's a currency matching point. You cannot discount cash flows in pesos with a dollar cost of capital. It makes no sense. So if you decide to value a Russian company in dollars, your discount rate has to be a dollar discount. So you tell me what currency you pick for your cash flows, I'll tell you what currency your discount rate should be. And as a follow-up, if you choose to do your valuation in real terms, what does that mean? Normally when we do valuations, do we do them in real or nominal terms? Nominal, we don't even think about it, right? Because where does a nominal slip in? It slips in all over the place. When we use historical growth rate, we're using a nominal growth rate. When we use discount rates, we use the T-bond rate as a risk-free rate, it's a nominal. So we do nominal without even thinking about it. You know when people do real valuations? When do nominal numbers become a pain in the neck? When you have inflation up 10,000, 50,000, 80,000%, you freak out. For simple reason, your Excel spreadsheet can't fit the numbers anymore, right? You have 18 zeros, 25 zeros. So real cash flows and real discount rates, I mean, especially in Latin America 20 years ago, it's no longer the norm. But 20 years ago in Latin America, people said, I don't want to deal with anything that's nominal. It's too scary. I'm going to do everything in real terms. Which effectively means that when you estimate the cash flows, you estimate the number of units you're going to sell. You keep a constant price because you can't build in an inflation into your price. You come up with real cash flows. If your cash flows are real, your discount rate has to be real as well. So consistency is something that cuts across in many different dimensions, and we'll come back and revisit all of these things because you think, who cares? Well, why would it matter that the cost of capital is in dollars versus pesos? That's the first question we're going to try to answer. Before we answer that question, though, we're going to talk about how we think about risk in a DCF model. I'm going to return to something I kind of said on the table last session or 2 sessions ago. Discounted cash flow valuation, cash flows, and you have a discount rate, right? Your cash flows are supposed to be expected cash flows. What are expected cash flows? In theory, here's what we're supposed to do. We're supposed to look at every possible scenario for your company, from very good to horrible, and take an expected value across those. We never do this, right? We cheat. We take the cash flow from last year, we put a growth on it, and we say we have an expected cash flow. But in theory, if you're doing a discounted cash flow valuation, your expected cash flow should reflect the likelihood of every possible scenario. And that was why I made the point of when you do that, don't tell me you've risk adjusted the cash flow. You're just doing what you're always supposed to do. It's the discount rate that carries the burden for risk adjustment. If you break down a discount rate, here's what goes into your discount rate, especially if you think about it. You start with the risk-free rate, right? You have to tell me what currency you're doing the analysis. Today's session is going to be entirely about the risk-free rate. You spend that much time on the risk-free rate, it's become a pain in the neck. Especially when you talk about some currencies. It's a real pain in the neck. Okay? I'm going to start with the risk-free rate. I'm going to come up with a risk premium for investing in the average risk investment. Again, a measurement issue. It's an estimation question. It's a question I have to answer. And I need a measure of relative risk. How risky is this company relative to the average risk company? You know what I'm trying to do? I'm trying to broaden this discussion beyond a beta. Because in corporate finance classes, we get narrowed down. Beta. Beta is just a measure of relative risk, right? So when you say the beta for a stock is 1.5, you're just telling me that this stock is 1.5 times as risky as the average stock in the market. I'm essentially saying even if you don't agree with me on betas, just give me a different measure of relative risk and I'm off to the races. I can just plug that in and say I'm going to use that to come up with my cost of equity. This is not dependent on the CAPM or modern portfolio theory. It's just a very common sense way of building up to a cost of equity. So the burden in a discounted cash flow valuation for bringing risk into the valuation rests on the discount rate. The expected cash flow is supposed to incorporate all the bad things that can happen to you and get built in as expectations. Now comes, I think, the twist that we have to think about. You sit down to value a company. Let's say you decide to value Dell, right, at 13, whatever it is. You think, is this a fair value? Now, one way you can think about risk is how risky is Dell to me as an investor? That's a natural thing to do. I'm doing the valuation. It's my perspective of risk that should matter. And what I'd like you to try to think about is not think about risk as measured through your eyes, but through the eyes of the marginal investor in the company. First, let me explain why. I don't know about you, maybe I should just talk about myself. I have zero chance of influencing the price of Dell. You know why? I don't have enough money. That's why I said I'm speaking for myself. You might be worth hundreds of millions and you might be able to do things that I cannot. But most of us here have zero effect on the market price because we're small. The marginal investor is an investor who owns a lot of stock in the company and trades that stock. So we're going to look at risk through that investor's eyes. And we're going to see that risk can be all kinds of risk. In fact, when I think about risk in evaluation, and people talk about risk as this big number, I think about all the different ways that risk can come in. It can be estimation risk versus economic risk. What's estimation risk? You and I could be wrong on the growth rates we used, right? We could be wrong about the earnings we have as a starting point. That's estimation risk. Economic risk has nothing to do with you and I not doing our work. It's the outside world kind of throwing all, curveballs at us and things we can't anticipate. The reason I kind of emphasize this is there is this deeply set belief, especially among value investors, that if there's risk, here's all they need to do more homework. If they do more homework and they work harder, the risk will go away. Well, that's true for estimation risk perhaps, but you can't make economic risk go away. I give you a Greek company to value. I don't care if you work really, 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 really hard for the next 6 weeks. Guess what? At the end of the process, you're still going to face a lot of risk because it's risk that is going to be there no matter how hard you work. And it actually takes a huge load off your shoulders. Because those people who think they can make risk go away by working harder are the people who are going to beat themselves up and think, I got it wrong, I got it wrong. Some of this you just have to let go. It's really not your fault. The risk can be micro risk or macro risk. What's the distinction? For Dell, for instance, give me some examples of micro risk. I'm sorry? It's related to the firm, but give me a couple of examples of, if you're valuing Dell, what are some micro risks you're worried about? What's the business they're in? The PC business. Last quarter, more tablets got sold than PCs. So one of the micro risks you face here is, hey, is this business is this a shrinking business? What are the margins going to be like? So that's micro risk. On top of that, you might ask, well, what's Michael Dell going to do? Is he going to do more acquisitions? Is he going to do more investments? That's micro risk that affects it. What's macro risk? Everything else, right? What's interest rates going to do? Is the economy going to come back? I mean, these are risks that are not specific to the company, but the company obviously is impacted by them. Micro risk is macro risk. And so why do you care? Well, when we think about what we want to build into the discount rate, we at least need to know where that risk is coming from, because depending on the perspective we take on the marginal investor, some of these risks we might not care about, and some of these risks we're going to try to build into the discount rate. The risk can be continuous risk or discrete risk. Give me an example of continuous risk. You're Disney, you have European operations. What's a continuous risk you're going to be exposed to every day? The euro moves, you are impacted, right? Give me an example of discontinuous risk. You're Disney, you have Venezuelan operations. What happened? Was it yesterday, day before? What did the Venezuelan government do? The problem when you have fixed exchange rates, you have extended periods where there's no risk and then a big risk, 32% devaluation. You say, why do you care? Which risk would you rather face in evaluation, continuous risk or discontinuous risk? I would much rather deal with continuous risk. It's so much easier to deal with, so much more convenient in terms of fitting into discount rates. The risks that scare me are discrete risks. Risks that, and I'll include things like nationalization, devaluations, default, because those are risks that are much more difficult to bring into valuation. So one of the first things I do when I sit down to value a company is I draw up a risk profile. I basically it's a free form. List up every risk you're thinking about, put it on a page, and then start putting it into buckets. And then let go of those buckets that you don't control. And then hold on to those buckets where you can actually do something about estimating it. It's incredibly freeing because it will give you the time to spend on those inputs where you can actually make a difference. Don't waste your time trying to forecast interest rates. That's not your job. So it's a good first step. It's actually just list the uncertainties that you face in terms of buckets. And as I said, the key thing here is to then look at those buckets through the eyes of the marginal investor. Now, if you're looking at a company like Dell or Apple or pretty much any mid-cap or large-cap company, you look at the top 15, 16, 17 stockholders. You remember your Bloomberg. You type in HDS, you get the top 17 stockholders in the company. Take a look. I'll wager that 15, 16, maybe all 17 of the top stockholders in this company are probably institutional investors, Fidelity, State Street, BlackRock. And odds are, you're almost guaranteed that none of these investors have just Dell in their portfolio. Again, I'm not asking for market portfolio. So don't even think in terms of the limiting case. These guys have diversified portfolios, right? They have 30, 40, 50 stocks, and that changes the way they think about risk. When you think about the risk added by Dell to their portfolios, not all of those risks are going to look the same, right? Remember in the previous page, you had micro versus macro. What are micro risks? These are risks that affect one or a few companies. You have 30, 40, 50 companies in your portfolio. Those risks are going to get averaged out. This isn't rocket science. You don't need Harry Markowitz or modern portfolio theory to show this. This is the law of large numbers. You have 50 companies in your portfolio. The micro risks, even if they don't disappear, are going to become much less significant. The macro risks are going to be there no matter how many stocks you have in your portfolio. So if you think about every risk and return model in finance, it's true. It starts with this assumption that the marginal investor is a diversified investor. You're saying, what if that's not true? We'll come back and examine that because we're going to look at the limiting case. To value private business, for instance, you cannot make this assumption. But as a public company, that's the assumption you start with. And every risk and return model in finance. Those question marks, I have no idea. The betas turned into question marks. Don't worry about it. Are there question marks on yours as well, or are they okay? Hopefully they should be okay. Yeah. There's still question marks on yours? No, they're okay. So basically, these are really not supposed to be question marks. Okay? So these are all the models out there. So let's review your choices. You have the CAPM. The oldest model out there, probably the most flawed, the most stringent assumptions. And guess what? Still the most widely used model out there because it still seems to work at least at the margin. And the CAPM, the expected return on a risky investment is the risk-free rate plus a beta. One beta captures all your exposure to macro risk because micro risk is assumed to be diversified risk. And one equity risk premium. That's a risk premium on an investment with a beta of 1, an average risk investment. If you expand it out in the arbitrage pricing model, you have the risk-free rate again as your base, but then you have multiple betas. How many? As many betas as you need to capture all the macro risk factors that drive stocks. The arbitrage pricing model is a statistical model. The factors don't get specified. So the factor 1, factor 2, factor 3, factor 4, factor 5, betas against each one. But it's a kind of an expanded version of the CAPM. In fact, the capital asset pricing model is a limiting case of the arbitrage pricing model, you're only one factor and one beta. So arbitrage pricing model allows you to have multiple market risks and multiple betas. So nothing earth-shattering. The multi-factor model kind of takes the arbitrage pricing model and makes it an economic model. So rather than call them factor 1, factor 2, factor 3, factor 4, factor 5, we call them interest rates, term structures. So essentially we attach a macro name to each. We don't arbitrarily do this. We look at the data to see which variable fits. So a multi-factor model allows you to have 4, 5, 6 betas and 4, 5, 6 market risk factors. And about 20 years ago, people discovered that we had so much data that maybe we don't need any of these models. We can let the market tell us what's risky and what's safe. That sounds odd, right? So here's what you do. You look at what stocks have earned high returns in the past and what stocks have earned low returns in the past. What if I told you that small cap companies have earned higher returns than large cap companies? You jump to a conclusion. That must mean that small cap companies are riskier than large cap companies. Why? You don't care. You've essentially given up on measuring risk. You're letting something else stand in for risk. The capitalization of the company, the price to book ratio. And I'll tell you, one of the dangers with having all this data that we have is every year people find a new proxy that works. And what you end up with are these proxy models where you essentially don't have an economic model for risk, but something that seems to have worked historically. You take every risk and return model in conventional finance, it's going to fall into one of these buckets or be some melded version of these models. I'll give you one very, very common melded version. You see the risk-free rate plus beta times equity risk premium. That's a CAP-M, right? But then you see a small cap premium attached to it for small companies. That's kind of a melded version of the CAP-M and a proxy model where you allow the market cap to kind of add to your expected return. But in every one of these models, what's your starting point? The risk-free rate, right? So let's not get ambitious about betas and risk premiums. Let's start with looking at the risk-free rate. And if you look at the conventional practice and how people use the CAP-M, here's what they seem to do. And we'll shred each of these practices apart because I think they're all bad. For the risk-free rate, what do they use? They use a government bond rate. You say, what else can you do? Maybe you start there, but you don't have to end there. For the beta, they usually run one regression of returns in the stock against returns in the market index. They take the slope of the line, they call it the beta. Or worse, they look it up in a service, Barra, Bloomberg, whatever, Merrill, For the equity risk premium, they look at the past, the last 50 years, the last 80 years, and usually they outsource this as well. They say, we got it from Ibbotson. Ibbotson, of course, is a data service that Morningstar owns that gives you historical premiums. I'm going to argue that each and every one of those practices is going to get you into trouble, but I want to start with the very first one. The risk-free rate might or might not be the government bond rate. To kind of see why that is, let me define what you need for something to be risk-free. At least in valuation, if you think about in corporate finance, you think about something being risk-free, a risk-free investment is one where you know exactly what you're going to make with certainty. Think about that. Absolute certainty. 99% of the time you have to have absolute certainty. Which means for something to be risk-free, here are the two conditions it has to meet. The entity issuing the security can have no default risk. Not an order, not a little bit, no default risk. And second, there can be no reinvestment risk. You know what I mean by reinvestment risk? You want a 10-year risk-free rate. A 6-month T-bill is not risk-free because at the end of 6 months you have to reinvest and reinvest again and reinvest again, and you don't know what rate. So already two basic propositions emerge, right? First is, what did I say most people use as the risk-free rate? They use the government bond rate, right? The minute you use the government bond rate, implicitly what are you assuming about the government's default risk? There's zero. Is that always the case? Is the Greek government bond rate a risk-free rate? End of the argument right there, right? There are government bond rates that are clearly not risk-free. So not all government bond rates are going to give you a risk-free rate. Second, if you ask me what is the risk-free rate, let's say this is an interview and I wanted a job. I quit working at NYU. I want a job. You ask me, what's the risk-free rate? At the risk of losing this job, I have to ask you over what time period, right? So I can't answer a question. First, I have to ask you what currency. Second, what time period. I can't just tell you what the risk-free rate is just as an answer because I have no idea. You want a 6-month risk-free rate, a 1-year, a 2-year, a 5-year, a 10-year, a 20-year, a 30-year, a 50-year? You might have very different answers depending on the period. So I'm going to take you through a series of tests, starting easy, and we'll build up the difficulty level on risk-free rates. And you're going to see why risk-free rates are not as easy as they look. first, let's start easy, right? You're doing a valuation in US dollars. How many of you have already picked your company? The rest of you, it's time. Pick a company. Soon, right? Pick a company. If you're doing a company, remember the fact is you can value any company in any currency. So you could pick a Chinese company and do it in US dollars. Let's say you've decided to do your valuation in US dollars. You want a risk-free rate in US dollars. And I'm going to give you 5 choices. And the 5th choice, none of the above, you better be willing to give me what you would do instead. I'm not willing to, I won't take any of these, but I don't know what I'd do. So basically, you've got to give me a. So here are your choices. And this is to do a valuation of a company. And remember what we said on the previous page about your requirements for risk rate. First, you could use a 3-month T-bill rate. Would you? What's wrong with the 3-month T-bill rate? Well, your cash flows in a valuation go when? How long do you, in a traditional valuation, how long do your cash flows go? That's actually deceptive. You stop after 10 years, but what happens after year 10? You assume stable growth for how long? Using the simple perpetuity formula, you're essentially assuming cash flows forever, right? So you want the longest term risk-free rate you can. So 3 months is out of the picture. You have a 10-year and a 30-year. In fact, on the 10-year, I can give you either the 10-year T-bond or I can give you a TIPS rate, which is an inflation-protected treasury rate. So which of those, if you were picking just the risk-free rate, which of those 3 is your best choice? No, he said it has to be the longest term. He said, hey, the 30-year rate. And you're right. If your only job was to pick a risk-free rate to value a company, you would use the 30-year T-bond. There isn't a single valuation you're going to see in this class where I use the 30-year T-bond rate. I'm going to use the 10-year T-bond rate. The TIPS rate is not even in the picture. Why is that? What's the TIPS rate closer to? We talked about real and nominal, right? A TIPS rate is really closer to a real risk-free rate than a nominal, so it's optimal. But here's my justification for using the 10-year. It's not as good as the 30-year rate in terms of capturing the risk-free rate. But remember, the risk-free rate is only one piece of the bigger puzzle, right? Because once I get the risk-free rate, what are the other things I need? I need equity risk premiums, and I need default spreads that I have to estimate, right? How do I get default spreads for corporate bonds? I try to find other corporate bonds with about the same maturity as my risk-free rate, and I look at the difference, right? Now do you see why I'm so nervous about going to a 30-year T-bond? I can get the rate for the 30-year bond, but to get the default spreads, then I have to find 30-year corporates. That's going to be really, really, really difficult to do. It's a purely pragmatic choice. I'm accepting a less perfect risk-free rate, the 10-year treasury, because it makes the rest of my job easier. It actually doesn't skew the discount rate one way or the other. It basically means that my risk-free rate is lower than it otherwise would have been, but my risk premiums are higher than they otherwise would have been because of the way I've structured the problem. But all these choices, what am I implicitly assuming about the U.S. Treasury? Maybe the answer is none of the above, because you're saying the U.S. Treasury is not default-free. And it's just not taught, right? What could you point to show me that I should be worried about treasury risk, default risk in the U.S. Treasury? So, one is I could look at the ratings agencies. Look, S&P downgraded, and look at how much blowback they're getting as a consequence. But if you wanted a number, could you point to? But we could always say rating. What do they know? No. What's the number you can point to? There's a CDS market. We're going to talk about that today. Credit default swap market, and whether you like it or not, that's a market where people bet on default risk. And that spread for the U.S. Treasury has gone from about 20 basis points 5 years ago to 50, 60, 65 basis points spread. So whether you like it or not, there's been this perception, at least in the part of the rest of the world, that there is default risk. So what do I do then? We'll come back to that, because we're going to talk about what to do when you have default risk. But file that away. The U.S. T-bond, when you use it as your risk-free rate, you are implicitly assuming that you're not worried about default risk. Now let's take one step up the difficulty ladder. You're valuing a company in euros. It's an Italian company. You want a risk-free rate in euros, right? You go looking for a government bond rate in euros, and I find a lot. In fact, I find too many. These are all 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 countries, all of whom have 10-year euro denominated. They're all 10-year euro bonds issued by governments. So if I just say risk-free rate is a government bond rate, then I'm home free. I just pick the Italian government bond and say that's my risk-free rate. But if you had to pick a euro risk-free rate, which of these would you pick as your closest one to a risk-free rate? What are your choices? You could pick just the country you're looking at. You could pick the Italian rate, but we know it's not default-free. How do we know it's not default-free? They're all in the same currency. The only reason for differences in these rates is this is not 1998. We have lira bonds and French franc bonds, and these are all euros. They're all 10-year bonds. The only reason there are differences is because people perceive more default risk in one country than in another. And we want something default-free, or as close to it as we can. So I think I've given away the answer. So what should I use as my risk-free rate? German. And don't get too caught up in the German. It's not the German part that attracts me. It's the fact that it's the lowest of the rates. In fact, you might even consider using the ECB. The European Central Bank has its 10-year rates, and they sometimes flirt a little lower than the German 10-year bond rate. You could consider using that as your risk-free rate, and your rationale is, I need something risk-free. Now, part of it is you're going to be screaming, but I have a Greek company. I want to punish it. Okay, I'll give you plenty of chances to punish your company for being Greek or Italian or Spanish. The risk-free rate is not the place to do it. Everybody comfortable with the risk-free rate in euros then? So we've gone dollars, we've gone euros. Let's climb one step further up the difficulty ladder. You decide to value an Indian company in Indian rupees on January 1st of 2012. On that day, the government bond rate, an Indian government has 10-year bonds, the Indian government bond rate was 8.5%. Now, before I use it as my risk-free rate, what do I need to check? Is there any default risk in this bond, right? And that's a tough question to answer in the abstract, so I cheated. I went to Moody's and I looked up their sovereign ratings. I know ratings agencies don't always get this right, but I need something to break the tie. And according to Moody's, local currency, if you're not familiar with sovereign ratings, Moody's actually gives you two sets of ratings for every country. A local currency rating and a foreign currency rating. The foreign currency rating is the rating they attach to your country when it borrows money in a foreign currency. So if India borrowed in dollars or it borrowed in euros, that's the rating that was attached to it. The local currency rating is the rating that the ratings agencies, or the default risk that the ratings agency sees when you issue bonds in your local currency. What would I like to see there? What would allow me to use the 8.5% of my risk-free rate? Assuming the ratings agencies know what they're doing. What rating would I like to see? A AAA, right? Because AAA, I can blame the ratings agency. Something blows up. It's not my fault. Moody's told me it had no default risk, but Moody's didn't give me that easy way out. The rating they gave me for India was Baa3. Not terrible, much better than it used to be, but Baa3 definitely has default risk. So I'm going to make an estimate of how much the default risk is costing me, and I'll come back and talk about how this has, I'll try to back it up. The typical default spread for a Baa3 rated country in early 2012 was about 2%. So now we're at it. You have the government bond rate. I've given you the rating for India and the default spread that goes with the rating. I need a risk-free rate in Indian rupees. Let me go through the choices, and you tell me when I get to the right choice. I could use the yield to maturity on the 10-year bond. At 8, that doesn't even make sense. Yeah. 8.5% saying it's a government bond rate. I'll use it as my risk-free rate. I could use the yield to maturity in the bond plus the default spread. Should I do that? What's my problem with the 8.5%? That it includes a default spread that it should not, right? Adding another 2% to it is actually double counting. I don't want the 2% in there. So in fact, I've kind of given away the answer. The 8.5% minus the 2% is my 6.5. That would be my risk-free rate in rupees. Having said that, you also have to remember that in many countries, government bond rates are not truly set by a fair market. What I mean by that is you see a government bond rate, but that government bond rate might either be a non-traded rate or might be skewed because of rules within that country about that bond. For instance, in India, one of the problems is banks are required to hold their regulatory capital. They're required to invest a portion of it, and this is by in government bonds. So they have to buy the government bonds whether they like it. So there is that problem that you're probably skewing the rate down because of those rules. So it's something to keep in mind. It might be a starting point, and then you might adjust for these little differences across countries. but you can already see the pathway then to getting a risk-free rate if you don't have a government that you view as default free. Any questions on this? So what's the key number you need on this one? It's a default spread for the rate, right? We'll come back and talk about how to get that, because once you get that, you're home free. So let's talk about the three ways in which you can get the default spread, the sovereign default spread for a country. Here's the first. If your country has issued dollar or euro denominated bonds, then you actually have a pathway to getting a default spread that does not require a rate. Let me give you an example. In January 2012, the Brazilian government had US dollar denominated 10-year bonds with an interest rate of 3.5%. So these are dollar-denominated bonds issued by the Brazilian government. On that day, the 10-year T-bond rate was 1.9%. Let's assume the U.S. Treasury has no default risk. My default spread for Brazil will then be the difference between the 3.5% and the 1.9%, which would give me about a 1.6% default spread. So that's my first. But to do this, what do you need? You need either dollar or euro denominated bonds issued by the country. So you could probably get away with this approach in a big chunk of Latin America, because Peru has dollar-denominated bonds, Colombia has dollar-denominated bonds, Brazil has dollar-denominated bonds, and parts of Eastern Europe, where you have countries that issue euro-denominated bonds. You can compare them to either the German 10-year bond rate or the ECB rate. So that's the first approach. See if your country has, or whichever country it is that you're looking at, has dollar or euro-denominated bonds. Here's the second. Talked about CDS spreads. There are 60, maybe 61 countries for which I can get CDS spreads. In fact, see this packet? I don't know whether all of you got it. I'll pass it back if you didn't get it. No. The last 3 pages of that packet have the CDS spreads as of, in fact, I printed that off at 12:45 today. So those are the CDS spreads for every country that has a CDS spread. Right? So if you get a chance, look at those last 3 pages, and you see CDS spreads for countries. You say, what the heck is that? A CDS market is like an insurance market. Here's how it works. You buy, let's say, Nigerian dollar-denominated bond, and you're worried about default risk. Let's say the Nigerian dollar-denominated bond offers you 6%. You can go to the CDS market and buy insurance. And the way the insurance works is every year, out of the 6.5% you get, you have to turn back. So let's say the CDS spread says 3%. You have to take 3% of the 6.5% and pay it as insurance. So it's like a default spread as seen by the CDS market. The CDS market has its own little quirks that make it a little troublesome. One is there's counterparty risk in the CDS market. What I mean by that is when you buy insurance, your insurance is only as good as the person insured. So it's not guaranteed like the forward and the futures markets are. So that can affect the CDS spread. And 2, there are little, the way it's set up, the definition of default is like dancing on the edge of a pin. This happened, in fact, last year. Did Greek actually default? Is it defaulted yet? Because there's actually a trigger that determines whether you get paid. So you might not actually get the insurance you thought you did if you don't meet the technical definitions of default. But notwithstanding all of that, it's nice to have a market where you can actually observe what people think about your default risk on a minute-by-minute basis. And the third approach to getting your spread, so in January 2012 for Brazil, that default spread with the CDS spread was 1.43%. So I have 2 numbers, 1.6, 1.43. And there's a third approach, which is if you don't have dollar-denominated bonds or a CDS spread, for instance, India doesn't have either of those, then you're stuck with the third approach. You have to take a rating, which you have sovereign rating for the country, and you have to look up what the typical default spread is for that country. And here's what that I'll come back to the table, but basically I'm going to take you through the process of all 3 using updated numbers. I'll use the January 2013 numbers. I've just given you the packet with the numbers as of right now. So this would be a good exercise for you to try out after class. Is pick whichever. You don't have to do every currency. That's kind of overkill. Pick one currency. Pick an obscure currency that you know absolutely nothing about. Nigerian Naira. I didn't even know what currency Nigeria had until I kind of had to dig through it. Pick a currency that you actually never heard of. See if you can work it through, because it's a skill set that you can draw on as you run into other currencies which might be stressed. So these are the local currency government bond rates in January 2013. Incidentally, this is the first page of the packet, and it gives you the website address that I use. It's a great website, because I used to have to It used to take me days to get these numbers because you had to go on Google. You can't go on Bloomberg doesn't have local currency government bond rates. I had to go on Google and do Google searches and searches of searches before I found it. I don't even know whether these numbers are right, but I don't even want to ask. It saves me a ton of trouble. So these are local government bond rates. So these are not risk-free rates, okay, for a bunch of countries. Okay. So they give you the updated numbers. So this is January 2013. Let's pick Brazil. Right? Brazil's right there, 9.18%. So the Brazilian 10-year nominal real-denominated bond, so these are not dollar bonds, had a 9.18% rate. So that's my starting point. I have the government bond rate in nominal reals. What do I need? I need a default spread for Brazil in January 2013. Let me start with the first way I could do it. We have those free copies of the FT lying outside. So pick one up. It's actually a great place to go, especially for this, because the Wall Street Journal doesn't do a very good job, especially when you get to these different currencies. Every day in the FT, they have a table which actually gives bonds, high yield, and emerging. You'll see this table. It's essentially emerging market bonds in dollars or euros. So what am I looking for? I'm looking for a Brazilian. So I'm trying to use the first approach where I use a dollar-denominated bond. So let me find Brazil. Brazil actually shows up twice. Why? Because they have a short-term bond and have a long-term bond. Which would I rather use? I want the long-term, so I will go with the 2020. Sometimes you might not have a choice. They've actually been very helpful. The last column, they give you the default spread of this bond against a T-bond of equivalent maturity. So based on the dollar-denominated Brazilian bond, January 2013, the default spread for Brazil is now down to 0.74%. You see where I get the 0.74%? Right there. So that's the first approach, try to find it. They really screw up when it comes to euro bonds. You see what their screw up is with the euro bonds? How do they compute the spread? They compare it against the US. These are euro bonds. What should they be these spreads computed against? They should be computed against the German euro bond rate. I've actually written to the FT saying, guys, you need to fix it. You can't be comparing apples to oranges and dollars to euros. But I'm glad they do it. At least I can do this. So it's not a big deal. If you have the euro bond rate, just remember you don't take the spreads as specified. Pick up the 10-year German bond rate, which is on the same page. So it's not even, it doesn't even take a lot of work, and do it right. So everybody comfortable with this approach? So you can already see the countries for which it's not a complete list. Bloomberg, for instance, has a more complete list of dollar-denominated government bonds. You can see if your government is on that list. With the second approach, I can go to the CDS market, right? This is January 1st, 2030, the CDS spreads. These are the sovereign CDS spreads. I'm looking at the Americas. There's Brazil. There's the spread right now, 142.45. Okay? You see, 142.45. This is what happens when fixed income guys report prices. Everything is in basis points. Right? Basis, because everything, 10 basis points. Huge move today. One of the nice things about valuations, we throw away percentage points all the time. Basis points, we don't know. This is 1.42%. It's not 142%. It's 1.42%. So now we have two reads on the default spread. According to the dollar-denominated bond, it's 0.74%. According to the CDS market, it's 1.42%. You can scan down. There's Venezuela. 5.92%. That number's probably, I don't know what the February, be interesting. What is it today after the devaluation? It's on the, how much is it? 6.34. I'm surprised it hasn't jumped up even more. Argentina is, of course, off the charts here, 20.02%. Don't cry for me, Argentina. So there's the CDS spreads. Any questions on this? So this will work for about 61 countries. You have CDS spreads as the default. Good question? You look like don't even try. Okay, because in fact, I'm going to give you a third number to make it even more confusing. Here's the third number. If you look at Brazil's rating, it's BAA2. It's local currency rating. And the default spread based on that is 1.75%. So I've got three reads on the default spread for Brazil. It's either 0.74% if I trust the dollar bond, 1.42% if I trust the CDS market, or 1.75% if I go. Now you should be happy that you had India. You know why? Because you'd have only one number. Nobody can complain about, hey, you got three. So here you have the luxury of riches. You got three different numbers. And the risk-free rate you're going to get is going to be very different depending on which number you use, right? So if you use the 0.74%, your risk-free rate is going to be the 9.18%, which is the nominal REI bond. So you remember where I got that from? That's actually from that very first page, 9.18%. Okay. Minus the 0.74%, which gives me a risk-free rate in REIs of 8.44%. If I use the 1.42%, I get a much lower risk-free rate, 7.76%. And if I give you the 1.75%, the default spread gets even lower. You say, this is a pain in the neck. I'm going to say something that's going to sound odd. Pick one. And if you're consistent, it's not going to matter that much. You know why? Because you know why these default spreads are going to come back? I'm going to talk about equity risk premiums. One of the ways I'm going to build up to a country risk premium is I'm going to come back and ask you, what's the default spread I should build this premium on? So if you use a really small default spread at this stage, you use a 0.74%, you'll have a much higher risk-free rate, but at the stage of the country risk premium, you'll also have a much lower risk premium for Brazil. What will get you into trouble is you start mixing and matching. You go back and forth between the different approaches, because then you can have inconsistencies in the way you estimate the basic risk-free rate. So any questions on the mechanics? So as I said, I've given you all of the raw data for the countries in today's in the packet, the February 2013 numbers. Take it and try it out. It's not rocket science. So you pick a country like Brazil, which has all three reads, and see what you can get. And then you can try to get fancy. Use a weighted average. Use a simple average. Do whatever you want, as long as you stay with that number when you get to the equity risk. Any questions? Now, one thing about the table that you think, how the heck, do you know how I came up with this table? I took every rating and I tried to find as many countries in that rating that either had a dollar-denominated bond or a CDS. So for instance, let's take BAA3. There were about 12 countries which are BAA3 rated, where I can get these numbers either from the CDS market or the dollar book. Then I take a median or an average. So basically, it's, again, I'm building off the same two data points because I know I will run into countries which don't have a rating or don't have a CDS spread or don't have. What if you have a country that doesn't have a rating? I get at least 3 or 4 emails from people who visit my page and say, you miss Serbia. I miss Serbia. The ratings agency missed Serbia. And then, of course, the follow-up question they ask is, what do I do now? What do you do? What do you think you should do if you have a country that doesn't have rating? No CDS spread, no rating. Sorry? Yeah, how high? Would that be high enough? Maybe there's a reason they don't have a rating. Is it to Afghanistan, Zimbabwe? Those are the countries you won't find a rating for, right? You had a PRS. PRS is this Europe-based outfit that gives risk. They come up with a numerical score for country risk by country. In fact, I'll put the link up if you're interested, because you have to pay for it, but I pay for it once a year, and they've given me permission to put the countries in little brackets. So here's what I do. You want me to estimate a default spread for Cuba, which doesn't have a rating. I have a country risk score for Cuba. So what do you think I do next? I try to find a country that has a rating, that has a country risk score pretty similar to Cuba. You say, this is reaching. Hey, what's your alternative? Use a really high number? I think at least I can come up with something. I'm not picking on you. Okay? Because that's what people end up doing. They make up numbers. So I'm saying, look, you don't like what I'm doing, then tell me what you're going to do differently. This is desperation time. My first question is, what the heck are you doing investing in Zimbabwe? But you insist, let me give you a number that you should be using, because without a number, you're in uncharted territory. So do whatever you need to do to get to a risk-free rate, because without a risk-free rate, everything else is going to start to come. Yes? Instead of a rating, there are actually that's what the PRS kind of score is. The problem with the Z-score, with any of those, is the advantage of ratings is they go with spreads. You switch to any other measure of country risk, you will then have to construct that linkage between that number and the spread. I'm not saying it's impossible, but I'm saying that's a linkage you will then have to develop. With PRS scores, I actually have developed a linkage. When you tell me the PRS score, I'll tell you the typical spread, but I've used the ratings to kind of get there in a backdoor kind of way. But there are lots of outfits out there that measure country risk, but they're really not measuring it for purpose of valuation. They're doing it for something else. Okay? So they tend to be big macro numbers, and I have to convert those numbers still into spreads. Okay? Any other questions? So let's complete the cycle. Let's suppose you wanted a real risk-free rate. So remember, real risk-free rate is you want to find something that has no default risk and is a guaranteed. That's why I put out the tips rate. If you assume that the U.S. Treasury is default-free, you can come up with a real risk-free rate in what currency? It's actually a trick question. When you're talking about real, there is no currency involved, which actually is a godsend. Because the real risk-free rate is 1% in the U.S., and it's a real risk-free rate that actually is not contaminated with currency. It should be 1% globally, right? One catch though. That's going to be true only if you have free movement of capital around the world. Because if you have free movement in capital around the world, here's why real risk-free rates have to be the same everywhere. If you have real risk-free rates of 3% in Brazil and 1% in the U.S., what's going to happen? Capital leave the U.S., go to Brazil, and it's a very strong assumption, right? Because we know that capital doesn't move freely around the world. It doesn't move freely into Argentina, it doesn't move freely into Zimbabwe, and even if it moved in freely, it's not freely moving up. Right? Ask YPF, right? So basically, it's an assumption you make of convenience, but that's the biggest problem with real risk-free rate is coming up with that base number. Start with that tips rate as a starting point. You know what the biggest problem you face today is using the tips rate? What's the tips rate right now for a 10-year tips? It's a negative number. It's kind of mind-boggling. You want a risk-free rate that's negative? Okay. You've made the choice. You want to do things in real terms. Get used to it. Real risk-free rates have become negative numbers pretty much in much of the developed world where you actually see those risk-free rates. So when you have a currency with no default-free entity, here are your choices. One is you can try to do what we did, try to get into a risk-free rate in that currency by subtracting out the default spread. I've also seen people use forward rates to back out a risk-free rate. You see how you can use a spot rate and a forward rate in a currency to get a risk-free rate? Remember interest rate parity? Do you do that in foundations? What does interest rate parity say about the relationship between the forward rate and the spot rate? You have the 1 plus the risk-free rate in one currency in the numerator, 1 plus the... So if you can tell me the spot rate in Thai baht and the forward rate in Thai baht, and you can give me the US dollar risk-free rate, there's only one unknown in that equation, right? Because I know the forward rate, I know the risk-free rate in US dollars. You can back into what the risk-free rate should be in Thai baht. I don't like it because you need long-term forwards to do it. You have to trust the forward market. But if it's another way of kind of triangulating to a number. It's another way of getting to make my risk-free rate even reasonable. You can do the analysis in real terms, but as I said, make sure your risk-free rate then is a real risk-free rate. If you're not going to use the tips rate, tell me what you're going to use instead. But most analysts, when faced with a currency where there's too much default risk, you know what they do? They tend to switch currency. Until about 5 years ago, 80 to 90%, maybe 95% of the equity research in Brazil was done in US dollar terms. Because they didn't want to do things denominated. There was no 10-year Brazilian, even the Brazilian government would not issue 10-year bonds denominated in reais. They would do it in dollars. They did not trust their own currency. So there's no harm doing that, but if you do that, go the distance. If you decide to do everything in dollars, your cash flows have to be in dollars, your discount rate, currency is a choice. Let's say you compute the risk-free rate. And I tried. It started 2013. I decided to compute risk-free rates in every currency that I could compute a risk-free rate. And I put them all on a graph. So let's say you're valuing a company. Which currency would you like to value? If you think purely in terms of risk-free rates, lower risk-free rates are better than higher risk-free rates, right? And the currency with the lowest risk-free rate is the Swiss franc. The currency with the highest risk-free rate is the Nigerian naira. interesting. This is a no-brainer. When I value a company, I'm always going to use Swiss francs. I'll get a lower discount rate and a higher value. What's wrong with that argument? Why do risk-free rates vary across currencies? Remember, these are true risk-free rates. I've taken out the default risk component. So if these are true risk-free rates, why do risk-free rates vary across currencies? Inflation. That's the only thing left. If you have a high inflation currency, you're going to have a high risk-free rate. If you have a low inflation currency, you're going to have a low risk-free rate. What one hand gives you, the other hand will take away. And here's why. If you decide to go with a low inflation currency, that's going to help you on the discount rate, right? You're going to get a lower discount rate. But when I get to the cash flows, what's going to happen? You have to be consistent. You're going to have a low inflation in your cash flows as well. If I pick a high inflation currency, it's going to hurt you on the discount rate, but you're also going to get a much higher growth rate in your cash flows. The key in valuation is to make sure that your inflation assumptions stay consistent, numerator and denominator. That's why I said you cannot mismatch currencies. You do a peso cash flows and you discount at the dollar cost of capital. I'll predict you will overvalue your company by a dramatic amount because pesos have embedded in them a 4 or 5% inflation rate. The US dollar cost of capital right now is embedding about a 1 to 1.5% inflation rate. It's not rocket science. You have mismatched the inflation. You are going to get too high a value. That's why currencies matter. That's the only reason currencies matter, is because they show up as inflation components in both your cash flows and your discount rate. So last page, and then we'll end for the day. The risk-free rate right now is what? T-bond rate, I think, broke 2% recently, but at the start of this year, it was 1.76%. And of course, the lament you hear from analysts is, it's a really low number. And then once they do that, then, of course, the next step is, should I be replacing that number with a more normal number? What's a more normal number? You tell me what your normal number is, and I'll tell you how long you've been working on Wall Street. Because you've been working only 5 years, your normal number is it's about 2%, right? That's what it usually is. If you've been working 25 years, it's about 5%, right? Because whether we like it or not, normal is defined by what we're used to. At 25 years ago, the T-bond rate used to be 8, 9, 10%. So what do you think about this idea of replacing the risk-free rate today with a normalized number? Suppose, let's say we did it, right? We took the 1.8%, we replaced it with 4%. More normal number, that looks more reasonable. Holding all else constant, what's that going to do to our discount rates? It's going to push them up. It's going to come up, give us a lower value. Let's say it gives us a value lower than the stock price today. Then what are we going to do? Rather than invest in the stock, we're going to invest in the risk-free investment and make 4%. What dream world is that? The first thing to remember about a risk-free rate is it's not some abstraction. It is an opportunity cost. What can you make today? And you and I might like to make 4%, might think we deserve to make 4%. You don't invent the world. You have to live in the world you're in, not the world you wished you were in. Today, your alternative is you can make 2%. And here's the other thing to think about. Why are risk-free rates so low right now? And for the last 5 years, what's kept them low? It's these crises that keep rolling around, right? So same crises that push down your risk-free rate are doing what to your risk premiums? They're pushing them up. So when we talk about equity risk premiums next week, that's the connection we're going to make. But try to think about these little details in risk-free rates. It looks easier than it actually is. But if you walk through the numbers, it's not that difficult.